I'm not sure much has been done. Luckily, I have Opuiyo by my left, who runs an infrastructure fund. Basically, what the pension funds look for, whether it's infrastructure or any project at all, it's ability to invest monies and to get those monies back, over the investment time frame. So typically, you want to invest in projects or transactions or funds that are run by promoters who have experience in that asset class. Secondly, with respect to infrastructure, assurances around the policy environment and that whatever contracts are entered either with government or other private sector participants, either in PPP arrangements, are adhered to during the life of the contract. That's a challenge that is not specific to Nigeria, but you find in most African countries where when there's a change in government, there are often changes in policies. The other issue is around whether you're investing in greenfield or brownfield assets, and what sort of, if it's a fund, what is the mix in the fund between greenfield and brownfield assets. Obviously, we like to invest very close to cash flows, as close to cash flows as possible. However, having said that, it's possible in a portfolio of infrastructure fund to have one or two greenfield assets, but predominantly brownfield assets. With respect to tenor, I'm not sure. I don't think tenor is really a challenge. As you know, pension funds, and particularly the funds we run, the members are very young. Some have up to 20, 25 years to go. So I think we have use of these monies for a very long time. So lastly is the returns on the project. So I think that, between returns, between, project promoters, their track record, and ability to back assets that are very close to cash flows as possible, I would say those are the three critical things.
I mean, we've grown our money market from about 1.75 billion to about 52 billion. On the same day, we launched a bond fund at about 1.5 billion. That's currently stuck at 4 billion. The bond fund has a longer duration. The money market fund has a shorter duration. What we have actually found is there is no incentive currently for anybody to save the long term, especially when you find that you have treasury bills or bank placements yielding double digits. Why are you going to take that extra risk? If you also look at the Securities and Exchange Commission's regulations on the money market fund, it says you have to hold a stable NAV, whereas on a bond fund, you have to market on a daily basis. The general populace in Nigeria, and that includes the man on the street, to the, all due respect, educated investor out there, does not understand that volatility. So when you have a bond fund which is being marked to market on a daily basis, and you have interest rates in Nigeria currently either 2 or 3 months ago, double digits, 16, 17%. Currently, a 30-day instrument, you'll find at about 3%. That volatility. Now, my opinion would be there has to be an incentive to save over the longer term than the short term. Now, it could be that you tax short-term profits or income at the expense of investing over the long term. It has worked in Brazil when inflation was high before the mutual fund industry kicked off. The government was taxing short-term. If you invested for anything less than 1 year, you get taxed. If you invest for over 2 or 3 years, then you don't get taxed. There may have to be that you are encouraging people to invest for the long term. The other bit that we've also found is for people to invest on the long term, you have to give them a reason. Historically and possibly currently in the Nigerian financial services industry, what a lot of people know about are banks. There are other savings vehicles, including collective investment schemes, including investment-linked products within insurance companies. But what you do find is that a majority of people just know about putting money in a savings account. It is through the educational effort of companies like FBN Capital Asset Management, the Fund Managers Association of Nigeria, that we've been telling people either you're saving for your child's future education, you're saving for you to do a master's degree or buy a car or saving for a house. When you give people that tenor to invest over the long term, then you possibly find a reason, people find a reason for investing that long term. If not, a lot of people have just been happy leaving it in a bank savings account. So there has to be an incentive, either from the government or from the regulatory authorities, to encourage people to save over the long term, as well as giving them that incentive rather than and disincentivizing investing over the shorter term.
At a very high level, the way we approach investments is somewhat similar. What we do is we look at from a top-down perspective. So look at a particular industry, look at the dynamics, more consultant type speak. Look at the industry dynamics, then move into the company-specific criteria. I think where things differ is because there's a realization that no two geographies are the same. The challenges, for example, you face in Nigeria are not the same things you face in South Africa, for example, despite the fact that it's in Africa. I think what we tend to do is we focus on management. Management is very, very critical. I think, in fact, you can almost say management is everything. And management is important right from the time when you engage with them. Management has to be credible. Execution is key. Then also some of the things being in an emerging market, given that we are not short-term investors, we are medium to long-term investors, there are things we also worry about. Fundamentally, we are dollar investors. So we have to worry about FX. We have to worry about policy stability. We have to worry about getting our money in, getting our money out, etc. And I think in that respect, things are slightly different. And also, there's also an important point which was mentioned by the previous panel, this notion of being able to attain scale. I think that's also very important from our perspective because we're not in the business of our ticket sizes are slightly larger than most people. So consequently, we're looking for businesses that have attained a particular stage. So we're more or less growth investors or replacement capital investors. So that's one of the things, those are some of the things that we look at differently compared to different markets.
Okay, so given the paucity of data, how do you overcome that challenge in trying to make sure that you've made the right investment decision? I mean, there's information out there.
Sure.
But you speak to different houses and you get 4 different answers. How do you overcome that challenge?
Good question. I think what we try and do is we triangulate from different sources. So obviously, you have your desktop research. We go steps further. We hire consultants. And also, more importantly, in markets like this, what we tend to find out is most data or information is gathered by actually speaking to people. So you speak to people, you speak to industry experts, you speak to friends, and I think just by gathering those kind of things, you can actually get a sense of where things are going. I think the other aspect of gathering data is you actually just have to roll up your sleeves and sometimes do a lot of market testing. So part of our diligence also involves speaking to clients. So when you have a management team, for example, you engage with a customer, a company, and they tell you, well, our industry is growing by so and so percentage, or this is the opportunity. What you try and do is you try and test that, both from a common sense standpoint, but also by speaking to other participants in the industry to get a sense for how true this is. And I think over time, especially given that we're on ground, you kind of are able to develop a sense that people who are either investing from abroad don't have. I think you are closer to the ground, you are able to understand what is true, what is not. And I think when you triangulate all those various sources, then you're able to develop a reasonably, well, it's not entirely clear, it can never be clear, but ultimately a reasonable range for you to be able to make your investment decision on the back of that. Yep.